Hi, this is Randy Finney with Right Side of the Chart, and this is a late session update for Thursday, April 4th, 2024. Not not a whole lot new to report today, just figured I'd do an update. I actually started working in the morning, stepped away from my desk, knocked off some errands, came back, sat down. There's some movement right now in the markets, but it's noise within the trading range. I'll get to that in 1 second. We've seen the futures or the indexes, however you want to look at it, turn just a little while ago here. But I just wanted to highlight the economic calendar, and what I'm going to do is segue into the charts on QQQ, particularly the weekly charts. Remember, today's Thursday. We're right here. We had a couple of jobless claims coming a little. I believe it was a little hotter. I looked earlier this morning. Doesn't matter. Didn't move things that much. Employment situation. This is the one to watch tomorrow, and going forward. Non-farm payrolls. Here it is. Prior consensus is for 200,000 jobs. So here's the range, 150 to 230. And remember, we've been in that bizarre world lately, which is the market only wants bad news. It wants to get bad news so it could get its rate cuts, which again, I can I try to really avoid the P word, promise, but I can all but promise you if once this turns, and gosh, I didn't have it queued up here. Maybe I can queue it up for you real quick. Once the jobs market turns, and remember, there is a lot of, you have to look into it, read up on the birth-death model they use to kind of guesstimate, really, which is wild, and they can be way off on the jobs numbers. But this one we're going to watch tomorrow. So there it is. You can see where the numbers are, the expectation, and then again see how the market reacts to it. But let me show you something here. Okay, so this is macro trends. That's macrotrends.net. Great. I use this site all the time. A lot of various economic charts, things to look at. Let's just look at unemployment rate here. Click on this chart, and I have the default is show recessions on there. And I pointed this out in the past, but this is what I want to talk about. So what happens is, and it's a valid point. Bulls are going to cheer and make a strong case for the market when unemployment's at lows. But you can see there's just these pretty clear and distinct trends, and the way it works is the unemployment rate falls, but once it turns or bottoms, it doesn't go sideways. Where by the way, these gray lines are the recessions. We're going back. I don't know, what is this one? 30 years plus. We're going back to 1948. We're going back over 70 something years here. 3/4 of a century, and you can see pretty clear stuff. The unemployment rate goes down. You hit these lows. So this is where we were back before the dot-com bubble. That's when the Nasdaq, when that recession started, the Nasdaq fell 78%. The S&P fell less because there was a bubble with the dot-com stocks. Not much different than I think with AI right now. That's where we were before the financial crisis. And here's where we are now. So what we know, going back, we haven't seen unemployment levels this low. We're below pre-COVID levels now, and that was the last recession. The line's so small, but it was there. It was over before you knew it because all the stimulus the government, both the Fed and Washington gave us. But you can see we go back all the way here to the 60s, really before. And then what happened in the early 70s. It was really late 60s to the early mid-70s. We had a series of recessions. Stock market went just about nowhere. It was one of the worst periods in really in history for the U.S. stock market. But again, just look at that. That's all. So take it out however you want. I always say there's a saying in the markets that it's always darkest just before dawn. That means think back to after the well, you're not looking at the stock market here, but in 2002, after that 78% drop in the Nasdaq, think back to 2000 and early 09, late 08, when both the Nasdaq and the S&P 500 had fallen over 55%. That was right here at the end of this recession. And so, there's the opposite. It's my thing. I made this up. It's just like it's always darkest before dawn is what they say. Well, it's always sunniest just before dusk, let's say, something along those lines. And that's what it is now. And that's it. We'll watch the technicals. We haven't broke 433 on QQQ yet unless we do. It is not an aggressive all-in short moment. Been throwing out a lot of trade ideas in different asset classes. We're diversified, and when that moment's there to hit the hammer down, I think it'll be a big one. And again, you can see here. Oh, and you have seen the turn, by the way. So is it a blip? This right here. Hopefully you can see it in the video. Let me zoom in nice and tight. I'm talking about this turn. So we've seen the unemployment rate ticking up right here. And let me grab my arrow tool. Is it a blip and we're going to do this? Possible, but again, look where unemployment has bottomed for going back now, 3/4 of a century, especially in modern times. I think it's safe to say times are a little bit different than back in the 50s and 40s back here and all that, pre-World War II or post-World War II and all that good stuff. So, all right, that's it. I don't want to beat a dead horse, but I just want to point that out. So watch it. So again, now the takeaway is, and we've seen it, there's been a clear pattern with the market rallying on bad news because, okay, we're going to get our rate cuts. The other chart, I don't feel like queuing it now. I've showed it to you many times. It looks identical here too with Fed rate hike cycles. Hiking cycles come right before the recessions, right before the start of the bear markets. And it's only once they start cutting, that's when the recession comes, just like the yield inversion. Remember, we're still inverted on the yield curve. I checked it this morning. You know what? I think I have that one up for you. And it's not it's well known as an indicator with a 100% success rate, calling the last, gosh, how many years, predicting the recessions without any whipsaws. Give me 1 second and pause the video. I know I had it pulled up earlier. Okay. Yep. Knew I had it somewhere. Okay. This is from Guru Focus. I like to use this site for the yield curve. And I had it zoomed out earlier. Let me go back to 10 years. If you want, you can go to all. You can see it here. Let's go to all on both of them. What I'm talking about here. This is I have to zoom in for you. I sometimes forget we're in video mode and you're not seeing what I'm seeing. So I'll blow it up here. That's the spread over the 10 year compared to the 1 year Treasury. And you can see it's coming back up. And again, it's not the inversion that immediately precedes the recession or close to it. It's the uninversion when you cross back above the line. And why? That's because the Fed is cutting short-term rates because the economy is turning. They're seeing leading indicators, the ones they like to go with or whatever reason, and they start cutting rates. And that's when the recession comes. Hopefully you can see it in the video. If not, go to the site and pull it up yourself, and you can see the shaded areas. And again, it has a 100% track record. And yeah, well, I've been talking about it. Others have for a while because we inverted. Typically, the uninversions come a little bit sooner. In the past, they have. But this kind of meshes with my big macro that I've been talking about forever and a day. A bear market, unlike others are even thinking about. Most are just thinking 2000, 2007 because it's recency bias. So I'm thinking something that's going to be play out with longer cycles and last a lot longer. And so this kind of fits with that narrative, whether it proves to be correct or not. But I just want to point out we're moving up, and so you're going to get your rate cuts this year from the Fed. That I promise you. The big question is how much are long-term rates going to respond? So the more that long-term rates, inflation, sticky inflation holds up, then the less we're going to see longer-term rates go down. There's also, and again, it's a whole nother conversation, but just you follow the headlines, I'm sure most of you, the tremendous amount of spending in Washington, this current administration, even the one before, they're both buffoons in my opinion, last two presidents, including the current ones. But the trajectory we're on is unsustainable. We're spending like it's wartime, and it's not. We're in peacetime. Our deficits, God forbid, this economy really stumbles, and we need to really stimulate and blow. What's going to happen is nobody's going to buy our bonds. Already, foreigners have really cut back in recent years on buying U.S. Treasury bonds because the only way out of this mess is to print money. Our interest costs on the existing bonds. And, of course, Yellen thinks she's brilliant, just rolling. She's just issuing short-term bonds because rates are high. Everyone's got this mindset, like interest rates aren't going to go up anymore. We've seen the top. If they keep going up, if long-term rates stay where they're at, even just stay where they're at, but especially go up. And you've got the U.S. now, again, the Treasury has been intentionally issuing on the shorter end of the curve to not have to sell, long date, higher rate 10, 30, 20-year Treasury bonds. And that works great if they're correct and everything comes back down, inflation comes down, and the rates are lower. It blows up goes the other way. And so the point is, the only way out of the mess of the U.S., the trajectory we're headed on with the current spending and everything else and our deficit blowing up is to kind of print our way out of it. And that means it's what do they call it? Strategic default. You're just printing money. You're just selling new bonds to pay for the interest on the existing bonds. It's kind of, it is a Ponzi scheme. Call it what you want. Okay, off topic here. Let's get back to the markets. I just wanted to point that out. And now let's talk. I'll hit on gold. I had the chart of gold up today. We had the first candle today was, I just got a price alert here. I'll check that in a second, MDY. This was the first candle. It was a 30-minute candle. Remember, there's 6.5 hours in the trading day. So the first candle of the day is really just a 30-minute candle. And we were below there. The next one, we broke down. We're below trend. It's not a hard sell signal because I like to see a solid close. I also like to see a solid 60-minute close. The first 60-minute candle closed right on it. We've been moving sideways. I'll still maintain that. And I think tomorrow we'll probably do the trick, the employment report. But right now, there's your level. You can see we've danced on today's lows all day, about 211.50-ish right there. So that needs to go. And in that post I gave you earlier today, just an update on GDX, I said certainly if you waited, because we didn't remember the other day, I threw out the short trade idea on GDX. Also said I wasn't so crazy about it because the euro US dollar looked bull. It was in a bullish falling wedge, positive divergences, and looked like it could pop and have a little run, and it did. And the thing is, it didn't really give that much more wind to the sales and the rally on gold and silver, especially gold and GDX. So they're losing momentum, and look, that's a big part of my trading and analysis. These are momentum indicators. The RSI, the PPO, and you can see so gold's still going up, GDX is going up, but it's going up at a lower, slower rate. And so like I said, depending if you just took it today or added to it today, then your cost basis is higher, and you can give it a little bit more room. You can cut the other way, obviously, when if the jobs number, or if the market or gold's response or GDX's response is positive. But let me just update crude now for you real quick. Okay, crude oil, aka the bane of Powell, I'll call it. You had a breakdown. There was a little wedge. Said you could take it as a, that and treasuries both. You can take those short crude and go long treasuries as an indirect hedge to a short on QQQ if you are in that short trade. And look what crude did. It broke down and it popped back up. So something must be going on somewhere. I don't know if there's any headlines out about it. But either way, nice reversal there. And again, this is just shows that this inflation is sticky. And remember, please don't forget, these to me are very important. They're a big part of my trading and analysis right now. These zones. This is USO. It entered the yellow zone. We certainly saw the market start to take note. We saw Treasury yields, going up. Then we entered the orange zone, just like Treasury. We're at the top now of that orange zone. And you go to the red zone, which is pretty much, I might have the line of hair low. It's supposed to see that previous reaction high, but we'll just leave it there. Remember, these are kind of, they're semi-tight levels, but they're relatively rough. It's just incremental. If we get into the red zone, we start moving up, you're going to hear more. You're already hearing what I've been saying you would hear about back here. If this trend continues, you're going to hear more and more talk about crude oil, sticky inflation, all that good stuff. And again, I showed you the overlay between Treasury bonds, and I'll just do an update there for you. IF, we're tracking that on the 60. This right now, here's a good example. We got back into the yellow zone. Remember, we're not in the green zone. We went into the orange zone. As I pointed out yesterday, we had positive, aka bullish divergence, and I've been putting a big fat asterisk on this, saying that if treasuries go up, here's what they're doing right now. Let's overlap the stock market. Let me turn off the after hours trades on here. All right. Now let me compare. This is a 1 minute chart of IEF. This is a 10-year bond. So bond price is going up, meaning yields are dropping. This, my friends, is a flight to safety bid. Let me tell you why. And that's why I'm being a little bit dismissive of it right now. Go here, compare it to QQQ. Don't trade SPY. I haven't in a long time. Okay, so if there's any doubt about this being a flight to safety bid, here's what's happened in just in the last half hour or so here. We had stock market QQQ plunge. Remember, we're just on a 1 minute chart. This is just today's price action right here. You can see them moving together. You see these sharp lines. Ignore that because remember, I just pulled up, hold on one sec. Oh, yeah. That's the close there each day, and it's going to correct. It's going to show I'm comparing on a line chart, so that didn't really happen. Those were gaps on QQQ. Just look at the intraday, how they trade together, right? You see them trading pretty much together intraday. From this is 1 day right here, another day right there, another day, and here's today. And all of a sudden, we just saw the futures just tank. And it's technically induced. I'll get to that in 1 second. But you see Treasuries going up. That is, and CBC, I don't see any headlines. There's nothing out there right now. They're not citing any reason for this move. So it's most likely institution. Something's going on. Somebody doesn't like it. It just shows. Look, that's not mere coincidence. Stock futures plunge, or the stock market. It's intraday. You can call it what you want to watch the futures. QQQ or IEF Treasury bonds jump up. And again, so that is more so, and it's 1 day. 1 day doesn't make a trend, but that shows you that the fact that we're in this IEF up in the green zone right now is that one asterisk I've been adding all along, saying that, hey, if treasuries are going up for the wrong reasons, meaning flight to safety because stocks are going down, especially impulsively, then that doesn't mean as much to me as it does when they're normally, if it's just other natural market forces causing this, such as inflation, everything else. So, all right, now let's get to QQQ. Here's a 60-minute chart. Here's a purple range. Let me just turn off all the lines. So here's that drop today, and it's noise, guys. All it is noise. There's nothing. Let me repeat, nothing technically significant has happened today, meaning we didn't break above support or resistance. And again, I've been saying this unless this is our trading range. I'll turn off all the lines and just box it in for you this way. Nope, I can't use that tool. I need to use this one here on the draw. That's the trading range. There's my big 433 support. And, anything in here is noise. And the MO, when you recognize the trading range, and that's what we did. Our last short was right here on Fed Day. We shorted the high of the range, and we're swinging down to the bottom, right? It's really one of the most basic premises and one of the easiest things in trading. You just can't wait too long, because once if a range gets super long in the tooth, sooner or later it breaks to the upside or downside, and that determines the next trend. Now, you guys know which way I think it's going. We're going to swing it to the bottom, and I made clear, I think if we get to the bottom, then we're probably going to go down through. So, that would be, either a short-term swing trade, relatively short-term, measured in days or weeks, and or if you shorted there for the longer, like I said, trying to swing for the fences, trying to hit a triple home run or a grand slam, then you're going to just, you got a good entry, set your stops and let it run to my deeper targets. Otherwise, it may just prove to be another move down if we get to the bottom of the range. But again, the MO has been when you go to the top of the range, that's where we shorted last time, the next stop is the bottom of the range, right? You zigzag down to get there, but that's what it is. All right, and so there's the drop today. We had a short entry here, objective short entry, one there. I said if we got there, and then the last one be up here, and I said this is where I don't want to see QQQ get much above that 447.50. We'll call it 447.50 is the level, so 448. And you can see there were a lot of sellers lurking there. So that's that. And again, the takeaway is the only thing, if you want to call it technically significant, this is one of the most impulsive moves down and without any news catalyst. It just kind of shows what's going on in the market. This is, oh, let me finish up here. I just want to do one more chart. I'll finish up and then we'll wrap up here. And that is the QQQ. We're going to flip over to the weekly. In the beginning of the video, sometimes I forget to do these things. This is what I wanted to point out to you. I've talked about this a lot in the past, but not in the last week or two. Up to a couple weeks ago, I did. Talk about the PPO histogram. I've just a very, very simple but fairly effective trend indicator. And we're going to turn off all the lines here. And today, of course, is Thursday. It is 3:05 as I speak right now. So we have 1 hour to go in the trading day. Tomorrow is the last trading day in the week. All that ever matters to me on a weekly chart is how you close the week. So I'll keep it very simple. Unless we close pretty green, we'd have to close, up 2, maybe 3% or more. We're going to get the first bearish PPO crossover on QQQ since right here on the weekly chart. And I've covered this many times in the past. I'm going to bring the line up. There's the last one right there. And it doesn't look like much, but that was the biggest drop we've had in this entire bear market rally off the, remember, the Nasdaq bottomed right, basically took off there. It had about an equal low. That's when we went bullish and long, covered all shorts, long Apple, Amazon. In hindsight, I wish I would have had them all the way up here and not even, just shut the computer down and held those positions. But no, we swung traded. We were, we had longs through there. We had shorts here. We had longs at the bottom there off the 200-day moving averages, and then so forth and so on. So it's been, swing trading. And I have to say that because you've got a few, borderline trolls on the site that make it seem as if I've been saying, short here and stay short the whole year. All right, so that's where we're at, and I'm going to show you this gave us that. This one right here gave us that. Let me measure it for you when I say this gave us that. That was about a 20% drop. It doesn't look like a lot, but that was it when we flipped. And by the way, remember when we were short at the top, we gamed each of these. We covered shorts and gamed each of these counter trend rallies too, in that last leg down there, and then long here. But there was a PPO bearish cross right there that started the bear market. And this trend right here, that was the bulk of the, or what I still call initial leg down right there. PPO flipped to green. We were bullish for that and other reasons, mainly divergences on the 60-minute charts, pullbacks to support, other technical development, key stocks at support, and then right there as well. So you can see it's done a pretty good track record, especially in recent years. You want to be long and strong when it's green, 401k type stuff or swing or trend type stuff. Remember, we've been locked in this trading range, and I get the frustration, the comments, and all that. But nobody, bull or bear, and I don't trade the S&P 500. I haven't in a long time. So this is my index here, and this is going down. And like I said, I've been in active trading mode as well in my active trading account. And I've also had in longer term accounts swing short positions that I have not and will not go to a full short position until 433 goes. That's where we're at right now. And again, the takeaway is there are no guarantees, but this is a pretty reliable trend indicator here. It shows, it's captured in recent years all the major trend changes, the ones that, again, a swing trader. I'm not talking an active trader. This is not a 5-minute chart. This is not the 15-minute chart or even the 60-minute chart. This is the weekly chart. And now, like I said, it's not finalized, so maybe they ramp it up here. Once in a while, it looks like you're going to cross. There's a good example. The lines kiss. That's the PPO lines right here. This is the histogram. Just shows you when these lines cross. That is possible. And even once in a while, you just get a whipsaw. Here was a sell signal. It said go short. Oh, and we had a whipsaw. It went green, and you had 4 weeks of whipsaw. But then the top came, and we went. So even if you just took this signal on faith, and that's all you did. Now, I don't think you should. I don't do it. It's not a standalone buy and sell signal. it's used in conjunction with other indicators, such as you turn back on all the lines, park the histogram over here. We'll see where we finish tomorrow. You've got the big negative divergence, just like you had the big negative divergence leading into the top in 2021, late 2021. Just like you had big, clear, positive, bullish divergence off the lows there as well. And still at the double low, that second low, almost equal low right there in January of 2023. You just extend those lines out. And so that's that. All right, so I'll wrap it up here. We'll see where we go. But yeah, I just wanted to kind of speak to that whole creep. I call it a creep back into the yellow zone on IEF. And again, like I said, not being completely dismissive of it, recognizing it, but telling you what it is as well, and clearly illustrating there is no argument because there wasn't any economic data. We had a couple Fed mouthpieces, talking today, and but that's normal. You look at the economic calendar; they're all over the place. They're talking almost every day, one or the other of them, or there's a bunch of them. Voting and non-voting members. All right, guys, I'm going to wrap it up here, and let me just see if there's anything else I want to cover. No, I'd love to do another update on the semis soon, SOXX, and I will. I'll do it in a separate video. You still have the same targets, and it's still good there. But this is it. The final one, I'll just say the king needs to die, and that's NVIDIA. NVIDIA, really, you can see, needs to take out 840 and then 742 in these levels, and that's when this stock dies, the stock market dies. I can say that with a fairly high degree of confidence. So I'll do another update on the semis, and remember that most already have rolled over, or put in those bearish engulfing candles. They've topped back here and moving lower. AMD, look at that beautiful breakdown today. Took out my 172. All right, guys, I'm going to wrap it up, get the video out to you, and we'll see what happens in the morning. If anything big happens pre-market, I'll get something out to you. Otherwise, I like to wait and see what happens when the big boys step on the field at 9:30 a.m. So I like to at least usually look at the first half hour of trading or so, and then I'll get something out to you. But until then, we're still in that sideways trading range, 433. We've got price alerts set. A lot of the sectors in the S&P 500 have got alerts set there as well. And, of course, the market-leading stocks. Some price alerts there that we still need to, some support levels that need to be taken out. This has been Randy Finney with Right Side of the Chart. Have a great day.